Hello, everyone. Welcome to the webinar and happy holidays. So glad to have you with us as we close out the year with one of our final webinars, which is also one of our most attended this year, or registered for, I should say. We'll see how many of you actually attend. But it is because it is such an important topic that really does affect all aspects of our financial and tax planning, which is Trump or the one big beautiful bill or Trump's tax bill, right? So we're here with Nicole Green. Hi, Nicole. She's back again. One of
Hi,
our
everyone.
one of our favorite speakers. She's a tax advisor at Robert Hall and Associates. She's going to get into the 10 major changes of the big beautiful bill and a lot of time here for Q&A. So looks like we'll be under the hour for the presentation, but Nicole says she can stay for Q&A. So if you have questions at some point, be sure to put your questions in the question box, preferably, because I have a feeling we're going to get quite a few. The Q&A box, you'll see it. It's next to the chat. If you want to say hi in the chat, feel free to come in and tell us where you're coming from and give us a shout out there with a city and state where you live or manage rental properties. That would be great to see you guys in the chat. But then if you have questions, put those in the separate question box area. We're also recording this. So obviously, we're going to go through a lot today. If you want to rewatch it, share it with a friend. Really, even people outside of the real estate industry could be helpful for. So feel free to share it. We're going to send the recording tomorrow via email with Nicole's contact information and the slides so you can review it again or share it. And lastly, I hope you all will stick around till the very end. I want to give you a little introduction here on Nicole because some of you might not have seen her speak with us before. She started with a focus in education in a bachelor's degree of science in education. And that love for learning really led her into the tax industry. And that's probably why she's such a great teacher of all the ever evolving tax codes and all the things that we need to know about. Is really a great match for her. She does hold a federal license as an enrolled agent tax practitioner, so she can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other kind of entity like that. And she is a frequent speaker. She has been recognized in numerous publications. So lots of experience with giving insightful tax advice and industry knowledge. And so it's a great opportunity to ask your questions to an expert like Nicole. So I hope you all will be active in the Q&A and listen in throughout this whole presentation. With all that said, Nicole, I'm going to pass it back to you to share your screen and start the presentation and say hi to everyone.
Well, thank you. Thanks for the intro. We are talking about literally my favorite subject. It's taxes. And the only reason it's my favorite subject is because there's so much you can do with it and so much happens with it. And so we're going to kind of break it up into three parts. First, we're going to talk about when do you really need to focus on your taxes and how can you benefit from focusing on your taxes. And then we're going to talk about Trump's one big beautiful bill, a little bit of a tongue twister there, because there's a lot of changes that might affect you guys directly or affect some people that you know, and just there's a lot of stuff kind of in the headlines that I want to make sure that we can clear up for people. And then I want to give an example of how we can really utilize some fun tax strategies for your with real estate, and you can see it. You can actually see it put into effect. So first, let me tell you just a little bit about where I come from. Robert Hall and Associates. Robert Hall and Associates is a tax firm. We're not necessarily an accounting firm. We're really a tax firm because all we do is focus on tax strategy. It is not a cookie cutter type of situation. We really like to customize people's tax strategies for what best fits them, and also what their goals are. I tell people this all the time. You can use your tax return like a super swift and deadly machete, or you can use it like a butter knife and pay a ton of tax. It's like up to you. You get so much control over it, and you just have to determine how you want to do it. And so that's why we really, really focus very much on creating people's tax strategies for them. One thing that we do offer is a free kind of discovery call to see what's going on in your tax situation. I sit with people all the time. I People find out that I'm a tax accountant. They have a bazillion questions because I get it. Usually an attorney, a doctor, and an accountant are very difficult to get a hold of. And so when you can find someone, they're like, wait, I have this question. No problem. We offer these free consultations, these free discovery calls, so that people can ask questions, people can get free second reviews. It's our way of kind of like reaching out to the community and saying, like, hey, we can help answer things because we truly, genuinely believe that the smarter people are, the better things happen and the better things that they do. If you have a questions, feel free to email me, nicole.green at roberthalltaxes.com if I don't have time to answer your questions today. So when we're talking about taxes, people usually focus on their taxes at the beginning of the year, right before they file. And I tell people, stop. Focus on your taxes in the year of. That will really, really help you a lot because one, we're going to stop with the interest and penalties. I believe the government has enough money. I believe that we don't need to contribute even a dollar more than necessary. And a lot of people sometimes have these small penalties added to their returns and they don't even know about it. And they just drive me insane. And knowing when you're going to get hit with a penalty, when you're going to get hit with interest, and understanding that so that you can prepare can really set you up for quite a bit of success. And then, secondly, you can actually affect your taxes in the year of. When people come to me in March or April and they're like, oh my God, my taxes are so high. What can I do? I'm like, nah, there's very little we can do. You can do some stuff, maybe depending on how you're situated in March or April, but there's really so little things that you can do. But at the end of the year, if you take just a little bit time at the end of the year, we can talk about all the options and we can really set it out so that you can now have control over your tax return and you can decide what's going to happen. If I contribute to retirement, if how's that going to affect my tax liability? How much can I contribute? Should I put more in? I was thinking about buying a car. There's even advanced strategies, DB, cash basis, plans that people can do, fee simples, conservation easements. There all of these types of things, but they all have to be done in the year of, or at least set up in the year of. And so it's really, really important for people to take a minute and just think about what are all the options because I believe that's what true wealth is when you have options. Not that you pick anything, not that you're the one that's super aggressive or super conservative. You just have the options laid out in front of you and you get to decide what you want to do. When we take away the options, we're reducing our wealth. But, and the last most important thing is peace of mind. And this is what we really strive for. I've said this before and I'll say this again. I personally believe that people don't mind paying taxes. I think it's the uncertainty of how much are they going to pay, not knowing when they have to pay, not knowing how they got to these conclusions. Are they paying too much? Could they have changed those taxes? I think that is what that's the issue people have about taxes. Obviously, where your tax dollars go, that's a whole other topic. But the idea of paying taxes, I generally think the world is okay with to an extent. It's just this uncertainty. And we here at Robert Hall and Associates really strive for people to have peace of mind, to know that they do have control over their tax situation. One of the main questions people love to ask me is, should we make estimated payments? Should we do our quarterlies? Oh no, I didn't do my second quarter tax payment, blah, 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 blah. Every accountant's favorite answer is it depends. It truly depends. And so the reason that it depends is because estimates or quarterlies, whatever you want to call it, is just one way to prepay your tax. Prepaying your tax can be done many different ways. And so it really depends on how you're situated and how you're set up to determine how we're going to prepay our tax. No, remember your taxes are due at the end of the year. A lot of people think your taxes are due when the filing is due, and that's not true. Your taxes are due at the end of the year. And you have to think that the government is really just kind of like a regular person. Let's imagine somebody owed you $20,000. Would you prefer that you said they have a year to make this payment? Would you prefer that they don't talk to you for the entire year and on the last day of the year they finally go ahead and make that payment? Or would you rather they check in throughout the year and be like, here's a little bit more, a couple $1,000, 5,000, and just kind of check in to one, remind you that they know they owe you, and then two, to reduce that payment. Obviously, people would prefer that they get that money a little bit throughout the year, just so that you know that they're not going to forget. And it's much easier for people to pay a few $1,000s over the year as opposed to paying just one big 20,000, 30,000, whatever it is. And so the government is the exact same way. And this is why they implement a lot of underpayment, failure to make estimated payment, late payment, interest types of penalties on people. And the list of penalties is outrageous. But that's just generally because they're trying to get their money. They need that money. Remember, you need to pay 90% of your current tax liability or 110% of the prior year's liability, whichever one of those is greater. And so if you're on W-2, meaning you have like just a regular standard job, or you have your own business, or you have a combination of both, you can control these things, but you're still needing to pay that 90% of current year liability or 110% of the previous year liability. Also, another thing, we don't want really large refunds, and we also really don't want to owe a lot at the end of the year, because when we owe a lot, that means just we're getting penalties. But really large refunds also mean that we just mismanaged our money in the exact same vein. And when people come to me and they're excited about a refund, I'm like, why are we excited to get our own money back? Like, it's your money. Keep your money and not be excited about, oh, yeah, you gave an interest-free loan to the government and then you had to beg and plead for them to give it back to you, which they do, but not in a timely fashion at all. Like, we're not excited about these things. We want to have a nice balance, and we really try for people to have a $2,000 swing either way. Either we're owing about 2,000, a little less, or we're getting a refund of about $2,000. And so that is all manageable. That is something we can predict, and that is something that you can control with just a little future planning. That's all that it takes. Okay, let's get into the one big beautiful bill. So, when presidents make tax changes, and almost all presidents actually, oh, almost all presidents have made tax changes and will continue to make tax changes. They make changes and they're all temporary, right? It's Congress that can make things permanent. It's Congress that enacts laws, blah, 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 blah. And so when presidents make tax changes, they are temporary. When Trump was in his first term, he made quite a few changes with the TCJA Act. Yes, the A stands for act, but we still say TCJA Act. And we knew that a lot of these changes were going to expire in 2025. And so whatever president came into office this term, we knew they were going to either have to continue the TCJA Act changes, they were going to have to create their own changes, or they were going to have to let the TCJA Act changes expire. We knew they were going to be one of those three options or a combination of those three options. And so one of the first things that Trump did with his one big beautiful bill is he extended the TCJA Act indefinitely. Yes, do they want people to think that it's permanent? It is until somebody changes it, because it's not actually permanent. Um, but so things like the corporate tax rate of 21%, that is going to change. The standard deduction, that is going to stay the same, excuse me, the 21% is not going to change. The standard deduction, that increased quite a bit, and that is also going to stay the same. The things that you've been doing for the last like 7, 8 years, you can continue to do. That's kind of the best way for you guys to think about it. Another thing that has changed is the child tax credit. So remember, credits are dollar for dollar tax, right? And so if you owe $10,000 of tax liability and you have a $2,000 credit, you only have to pay $8,000 of tax, because your credit is going to take away the actual tax. And so one of the changes is they increased the child tax credit from $2,000 to $2,200, so an extra $200. And they also have increased, they've set for the child tax credit to continuously increase based on inflation. So that's actually quite nice so that it can keep going up. Salt taxes. This was one of the really hard changes that was made with the TCJA Act. They capped the salt taxes. And so when we're itemizing, on your either you itemize or you take the standard deduction, whichever one is bigger is the one that we're going to do, right? And so when we're itemizing, we're adding up our medical expenses. And remember, medical expenses are only, they have a floor. It's 7.5% of your AGI. So if I have $100,000 of income and then I have $8,000 of medical expenses, only 500 of those medical expenses is going to be deductible to me because the first 7,500 is going to not be deductible. So we add up medical expenses, we add up salt taxes with state and local taxes, you add up mortgage interest, and then we add up charitable deductions, and that's how we get to the itemized deductions. Now, salt taxes have been capped at $10,000. Salt taxes, state and local taxes, again, we call it salt taxes, even though the T stands for taxes. I don't know why we do this, but we do. State and local taxes are income tax that we pay to the state, sales tax, city tax, property tax, those types of taxes that you pay. Those are all deductible on your federal return, and they've been capped at $10,000. And so if you live in a high state tax state like I do, I live in California, but like New York, Montana, Texas, even though Texas doesn't have income tax, it does have high property tax because the state does need money. Um, but if you live in a high state tax state, then that $10,000 cap is really, really painful. And so now that $10,000 cap has increased to $40,000 if your AGI is under 500,000. And this will be effective for 5 years. And so this is really, really nice because one thing that we really try to strive for people is not to create deductions, but to find things you're already spending on so that we can use that as a deduction. It's not necessarily go out and spend more money. It's what am I already spending on and see how we can use that. And you're already spending money on salt taxes. And so it going up from 10% to 40 or $10,000 to $40,000 is a really, really nice thing. Another thing that's been in the headlines is the no tax on tips and overtime. While it's not 100% no tax on tips and overtimes, it's no federal income tax on tips and overtimes with limitations, of course. So tips and overtime is still going to be subject to payroll taxes. Payroll taxes are like Social Security, unemployment, those types of taxes that you just see pulled out of your paycheck really quickly. And it is also going to be still subject to state income tax. But on the federal side, you're able to deduct up to $25,000 of tips for people that earn under $150,000. And so if you're a joint filer, it can be $25,000 on one person, or it can be a combination, but it's going to cap at $25,000 deductible of tips on the total return. While overtime, you're able to deduct up to 12,500 per person. And so if one person has $13,000 of overtime and another person has 12,500, you can deduct up to the 25,000 total for that joint filer because it's 12,500 per person. Keep in mind, again, your AGI does need to be under 150, and this is just for federal and just for federal tax because you're still subject to payroll taxes and it's still subject to state income tax. Another thing that's been in the headline is no tax on Social Security. And this is kind of true, kind of not. Let me kind of explain. You have to really understand how Social Security is taxed. Social Security is taxed completely different than like interest or earned income or something like that. There's three different brackets of taxes for Social Security. It's either 0%, 50%, or 85%. How do you know what bracket you fall in? You take all your other income beyond Social Security and half of Social Security and you add that up. And if you're a single filer and it's $24,000 or less, you're going to be in the zero tax bracket. And so 0% of your Social Security would be taxed. If you're a single filer and it's 24,000 up to 34,000, then 50% of your Social Security is going to be taxed. And then if it's over 34,000, if you're a single filer, then 85% of your Social Security is going to be taxed. Please remember, Social Security is never taxed at 100%. That doesn't exist. And then also some states don't tax Social Security as well. Like California doesn't tax Social Security. But what Trump has done is he has gone in and he has put in a $6,000 deduction for people. And this $6,000 deduction is for people that earn less than $75,000 a year. And so this is going to apply to a lot of those people that are in that 50% range and then the people that are at the bottom of that 85% range. Because a lot of those people in that 50% range and that 50% bracket are less than $75,000. Actually, they all are less than $75,000. And so that now is going to knock them down into that 0% bracket, which is quite nice. It's going to knock a couple of the people in the 85% bracket down, but not all the people because it's 34,000 and up type of thing. But they do still get a $6,000 deduction if your AGI is 75,000 or lower, or 150 if you're married filing joint, because two people. So that's really, really nice for quite a few people on Social Security. The next one is still about itemized deductions. Normally, like when we were talking about itemized deductions, we had medical, we had salt taxes, and we have interest. And it's usually mortgage interest, right? If you have a loan, a mortgage on your primary residence, and it is less than $750,000, your mortgage interest is completely deductible. If you have a loan for more than $750,000, you can only take $750,000 worth of your mortgage. For example, if your mortgage was $1 million, we can only, and your mortgage interest is $10,000, we can only take 7,500 of a deduction. Now, we can also add not just mortgage interest to that, but we can add auto loan interest that you can deduct up to $10,000 a year of auto loan interest. All that you need is to have paid the interest in the 2025, because this is effective for 2025, and the vehicle to have been assembled in the United States. It doesn't need to be a new vehicle. It doesn't need to be a new purchase. You just need to have owned and paid the vehicle in 2025. And obviously, there is a phase out range of $100,000 for single filers and $200,000 for joint filers. And so this is another thing that's actually quite beneficial because we're finding more deductions. You're paying your loan regardless, but now we're able to count it as a deduction if you're going to itemize. And so this is kind of cool. One of the favorite things is bonus depreciation. We were so happy to hear that bonus depreciation was back. Like, oh, yes, round of applause completely. We're going to talk about depreciation a little bit later. So let me first kind of just break down what depreciation is. When you purchase an asset, when you purchase a real property asset, it is spread over time as a deduction. So if I bought a business vehicle, let's say I bought a business vehicle for $100,000, I am going to deduct $20,000 over the next 5 years, basically, because it's the business vehicle and it is spread over 5 years. The timeline for things being deducted is predetermined by GAAP, General Accepted Accounting Principles. And that timeline doesn't really kind of change. But bonus depreciation allows you to take your future deduction and pull it forward. And so if I bought a business vehicle, I am now able to take 100% of that deduction in the first year, the year that I put it into service. Do I have to take 100%? No. And this is where, like, this is the money. This is really, really one of those things that show you just how much you can use your tax return. You can take 10%, you can take 100%, you can take 80%. You can decide how much you're taking. And so if we know this year we have a high revenue, we have this expense, and next year we know revenue is going to be a little bit lower because we're still working on the project, whatever the reason is, yes, let's go ahead and accelerate that depreciation. Let's go ahead and take more of that deduction this year because next year we don't necessarily need it to be so intense. We're going to leave some or we're going to take it all, whatever. We can kind of figure it out and play with the numbers. That way we can help balance our tax and keep it pretty consistent, lowers the chance of audit, and it also helps you with your planning because nobody wants a really, really low tax year and then a really, really high tax year. That's how we hit AMT. That's how we can get into a lot of extra kind of things. And so, even though your business might ebb and flow, you're still able to, there's these tools that you can use to keep your taxes actually quite consistent and predictable, which is very, very handy, even though we ebb and flow. And so we can see a lot of businesses really, really taking full advantage of this bonus depreciation. One really kind of fun thing is during COVID, people were able to take, people that took the standard deduction were able to take $300 of a charitable deduction on top of the standard. Now, remember, if I'm taking the standard deduction and I contribute $1,000 to the Red Cross or UNICEF or whatever, nobody cares on the tax return side. Nobody cares. It doesn't mean anything because you're taking the standard deduction. If you're itemizing, we care. But on the standard deduction side, we don't really care. But because they added that $300, basically, people were able to have increased their standard deduction during for the one big beautiful bill, they said that people that take the standard deduction, they can have $1,000 of a cash charitable deduction on top of their standard deduction. And so your standard deduction essentially has just increased by 1,000 if you're single or $2,000 if you are married filing joint because people are obviously contributing to I mean, in some way, a GoFundMe, a charity, a church, a temple, or something. People are given, a little bit of money, and so you now get to count it, even though you're not itemizing. So very, very beneficial. Baby bonds or Trump accounts, as they're also referred to. These are going to be opened starting in 2026, and it's going to apply to any child that was born in 2025 all the way up to 2028. And this is a way to help counter the idea of Social Security. I know a lot of people are afraid Social Security is not going to make it when they get old. It's also not enough. There's all the things about Social Security and its failings. Well, what they're going to do is they're going to seed a retirement account for for almost any child born between 2025 and 2028. The parents will go on and create these accounts. They have not been opened yet. They cannot be opened yet, but they will be effective for kids born in 2025, and you'll be able to do it in, I believe, second quarter of 2026, and they will act as essentially a retirement account. Think of it like a traditional IRA. The government puts $1,000 into the account. Additional family members can contribute $5,000, up to $5,000 into these accounts as well. And that money, the idea is the money will sit there and grow and grow and grow. And so then when the kid retires, they will actually have a substantial amount of money in addition to other bits of retirement. And it's going to be pre-tax because it's going to act like a traditional IRA. And I want people to remember that even though it's locked up in a traditional IRA, it's not fully locked. You can still take money out for some things. And yes, there are limitations, and it is not the easiest of things to do, but you can take money out for buying your first home, for medical expenses, for college. There are ways that you can take money out of these accounts. If you take money out for non-sanctioned things, then you do pay a penalty. But nonetheless, these accounts can really, really be quite beneficial. When I was a child, my parents contributed, I earned money and I contributed, it was me, contributed money into a Roth. And I promise you that it was no more than like 15 or $16,000 that was put into a Roth account. And currently that account sits over six figures because retirement accounts are all about time. Compound interest, growing, growing, growing on top of growth, on top of growth is so beneficial. And it's also a really nice, clean way for other people to contribute. You've got a friend that you want to give money to their kid, but you don't want to give it to the parent. You can now put money into these accounts for those kids for when they get older and they can grow, and it can be quite a nice investment for them. Um, EV credits and also solar and wind credits. We've been living high on these credits for quite a while, and they have come to an end. I don't know if people remember when Elon and Trump were having a little fight there in public. And this is rumored to be part of the reason. Um, but what it is EV credits have ended. Remember, people were getting about 7,000 or 5,000, $7,500 of a credit when they purchased or leased a electric vehicle, and those stopped in September of 2025. No more credits were being issued out. A lot of people were also reducing their purchase price of the vehicle by the credit. You could give the credit to the dealer as well. And so those are over. If you purchased a vehicle before September 2025, an electric vehicle before September 2025, you can still use your credit, but there's just no more credits to get. And then solar and wind credits are also phasing out. There's different types of solar and wind credits, and so those phase out ranges are changing, are different. But essentially, second quarter of 2026, they will all be completely phased out and completely ended. People were or are still buying solar panels on their houses and different types of things, and you're able to get a 30% tax credit. And remember, credits reduce your tax dollar for dollar. And the solar credits actually can carry forward. EV credits were not able to carry forward. So if you didn't use the credit or all of the credit, then you would lose the rest of the credit. But solar and wind credits, you were able and are able to carry forward. And so if you don't use all of the credit, you can use it the next year or the next year until whenever you're able to finally use it. On a side note, a lot because, renewable energy has been a thing, EV has been a thing, and it's becoming much bigger of a thing. People created these entire businesses setting up infrastructure for these types of things. They rented out fields and they created these mass like solar panel fields where, they're taking the sun and doing all the things. They created charging stations, right? A big charging stations. These are actual businesses that people did. And they obviously get revenue from those businesses, but they also got credits. And some of those people, quite a few of those people, saw that as another avenue for money. And they got credits just because they created the solar panels, just because they bought the solar panels. And they sold some of these credits, and they are selling the credits. So sometimes these companies have $30 million of energy credits, and they will sell these credits at a 5 or 10% discount to the outer public. You have $10,000 of tax liability, and you can go buy a $10,000 credit for $9,000. You just saved yourself $1,000, and because these credits are ending, I imagine in the very near future, there's going to be some flash sales happening with these companies that have all of these credits, because if we don't use them, what's going to happen to them? And so I imagine that people are going to be able to buy some credits quite cheap in the near future. Just a little caveat. I do want to talk a little bit about educators' expenses because I'm a former educator. I work at Robert Hall Tax Firm, and Robert Hall himself is also a former educator, and also his wife was a former educator as well. So this is a little soft spot for us. Civil servants used to be able to deduct things that they purchased from their for work, right? If you're a firefighter and you got to buy some gloves, jackets, boots, whatever, and you pay for it out of your money, your own personal money, you used to be able to deduct that. That has stopped for many years, almost 10 years, that has actually not been a thing. And now that's actually going to stay not a thing. That's officially not going to be a thing anymore. So if you're buying things and you're a civil servant and you're buying things for work from your own personal account, you need to get reimbursed from your job. Just like when people say to me, hey, Nicole, I work from home and I work for Chase or JP Morgan. I want to use business use of home. I'm like, it's not your business. It's JP Morgan's business. And so you need to go talk to Chase or JP Morgan to get business use of home because you're a W-2 employee. And so that's the same thing if you're, a police officer, firefighter, nurse, or whatever, and you're buying things you for work. You need to get reimbursed from your work. Your tax return is not going to be a place for you to get compensated. But teachers have been able to take a $300 deduction. And it's usually K through 12 teachers that has now been expanded to non-classroom teachers and athletic teachers as well. And so this is nice because everybody knows that it's not just the teacher in the classroom that educates your kids. It's actually quite a few bit of people that are going around and educating your kids, and PE coaches, trainers, health teachers, all of those people should definitely be included. They have also taken that $300 cap and they have said that it will be completely lifted. However, it makes no sense for it to be uncapped entirely, and the IRS has asked for additional time to go ahead and give clarity on that because it can't be uncapped completely. There's going to be some sort of calculation to that. And so this will be effective for 2026, where teachers will be able to have a most likely a larger deduction for things that they have purchased for their classroom, which is going to be quite nice. Okay, so on the third part I wanted to talk about is I wanted to show you how people can really use real estate to benefit themselves on the tax return. And this is just one strategy. There's many other, well, I don't know about many, but there's several other strategies that people can do. Actually, quite a few other strategies that people can do. So a cost segregation, or a cost seg for us in the biz like to call it, is where you're going to accelerate your depreciation. You're going to move it forward. Remember, we now have 100% bonus depreciation back on things that have a 5, 7, 10, or 15-year life. And so when you purchase a home and it's a rental property, not a primary residence, we're only talking about business because you don't depreciate your primary residence. You purchase a home, it's going to have a 27.5 year timeline. And so if I purchase a home for $200,000, I'll probably have like 140,000 of usable depreciation. You don't depreciate land. And so that's, a few $1,000s every year I will have of a deduction. Well, if I go and get a cost segregation, I go get an analyst to go to this house or look at it online or however they want to do it, and go and itemize the house and say, okay, you purchased the home for $200,000. The windows are $5,000. The carpet is $2,000. The refrigerator is $1,000. Well, all of those things have their own life. The windows are going to be on 15 years. The carpet is a 5 year. The refrigerator is a 7 year. Whatever. All of those things are going to have their own life. And so those things will be subject to bonus depreciation. They can be accelerated. And so now, instead of having a few $1,000s of a deduction every year, in the first 3 years, I can have a ton of deductions in that first year because I'm going into the future and I'm pulling forward those deductions that I would have. I'm not creating new deductions, I'm taking them from the future, which is something that we truly believe in. In the tax world, we tell people it's the 3Ds: delay, delay, die. And so if we can go ahead and do that, it's a really, really nice advantage. But we only want to do it for people that it makes sense for. One, you need the deduction to be large enough that it really makes sense. And why are we taking away a future deduction? If we're trying to increase our portfolio, fabulous. This is a really, really great strategy for people that want to grow their portfolio. And I want to show you an example. If you want to take your tax savings and go on vacation to Tahiti or whatever, I would say no, this is not the strategy for you because you're just putting tax in the future, right? We're just creating future tax. But if my portfolio is 3 times as big, that's okay because now I have even more money and there's even more strategies that I can do. So let me give you an example of how this actually is effective. In this example, you can see here, this person has 2 rentals. One is really, really old and one is brand new. And so the really, really old one doesn't have a lot of depreciation because normally when you have a rental, you're on your tax return, your rental is going to show up as a loss or a very, very small gain. We want there to be a larger gain in your pocket, but on the tax return side, it will show up as a loss or a very small gain because of depreciation. And so they have one rental that was showing up with a lot of gain, and then we have another rental that was kind of brand new that really wasn't. And so, putting them together, we're showing $33,000 of positive income. Our total tax was $20,850. We care about total tax. Don't really, I mean, we care, but we don't really care about, if we owe, if we, are getting a refund. We first want to talk about the total bill, and then we talk about how it gets paid and when it gets paid. But first you focus on that total bill. And so this here, they had the $33,000 of profit from the rental, and they had $20,000, almost $21,000 of total tax. They went and did a cost seg on the new rental because this was the first year that it was put into service. And this gave about 40 some $1,000s of usable depreciation that they were able to accelerate. In addition to the depreciation we've already used, my dog is coughing in the background. In addition to the depreciation that they've already used, we had about 40 some odd $1,000s of depreciation that they were able to accelerate and bring forward. And that took their tax from almost being $21,000 to $11,609. It dropped that tax. And so that tax, I mean, this is on the federal side. On the state side, if the state, depending what state they're in, certain states conform to cost segs and certain states don't. Um, you're also going to see a tax savings there. And then next year, there also is going to be some tax savings. And the next year, there's also going to be, you usually see it in about 3 years, you'll see the full effect. And so you now take this tax savings, take this $10,000 of savings, go put it into another rental. Maybe, okay, $10,000 isn't necessarily enough, but you take it over the next couple of years and then you go put it into another rental, you do another cost seg, we have another more year of really, really low taxes, and then rinse and repeat, doing this same strategy over and over again as you really expand your portfolio, and you don't have to put in new money. You don't have to do that. You're using your tax money that you were going to pay already. That money has already been accounted for, and you're using it to grow your portfolio. It's a really, really keen strategy for people to use. Not the only strategy. There's multiple strategies for people to use: real estate professional, DB plans, fee simple. There's a ton of things that people can do. And I always tell people that you just need to figure out what works best for you. When we sit down and talk with people, I tell them very much it's everybody wants to lower their tax bill liability. I know that. That's obviously a fact. But how aggressive do you really want to be? What really else works for you? You have a mother-in-law that's getting ready to move into you. How can we use that to your advantage? You have kids that are getting ready to go off to college. How can we use this to your advantage? What can we do to set you up? Because it's not just lowering your tax liability. There's actually quite a bit of other things that people can do to kind of help them out. Okay, I've talked quite a bit. Let's see if we can open it up for some questions now.
Yes, absolutely. That was a lot. Well said, very efficiently said, I might add. We also have just a quick poll question. I don't want to forget to ask it. If any of you are interested in the $50 off your tax preparation fee, say yes. I will connect you with Nicole so you can get that offer. Of course, if you also emailed or did the QR code, let them know you're coming from AAOA. That'd be great. And I'm going to leave that up for a little while. We can dive into questions. So if you can put it in the Q&A box preferred so I can keep better track, not the chat, that's going to help. I'm going to go through the Q&A first. So Beatrice started, first question, what is the maximum gross for a single taxpayer before the property tax of $40,000 starts to be reduced? Perhaps we need more context.
What's the maximum gross of a
For a single taxpayer before the property tax of $40,000 starts to
The
be
A. Oh,
reduced.
okay. I think she's talking about the salt taxes.
Ah,
Five hundred
yes.
thousand dollars. So $500,000 AGI for both married filing joint, head of household, or single, and then it goes down.
Great. Okay. Thomas also asked with Social Security, do both husband and wife need to be on Social Security or just over 55 years old?
Social Security deduction is going to be for anybody that's taking Social Security. And so if one person is taking Social Security and your AGI is less than 75,000, then you're able to get that $6,000 deduction for that one person. If both of you, then each of you will get that $6,000 deduction.
Awesome. Okay. Weldon asks, is retirement payments from a 401k or IRA counted as income for Social Security?
Yes, any type of payment, any type of income is counted, whether it's earned or unearned. Well, passive or earned income is counted in the Social Security calculations.
Great. Schlau, if you have a capital expense, i.e., an upgrade electrical system to maintain rental income, can you use this as a business expense?
It'll go against the rental expense, like it goes against the rental income. And if you did like a reno or something like that, it's going to be depreciated most likely over 27 and a half years. If you can get it itemized, depending on how much you put into it, if it's less than safe harbor, you'll be able to take it as a straight deduction in the first year that it is done.
Nice. Okay. Alan is asking about charity. So, is the donations benefit available for the 2025 tax year? I think I read somewhere that it doesn't count until 2026.
2025.
Right.
2025, you'll have $1,000 charitable deduction.
Amazing. Clem also asking on that topic about itemized deductions. Can I claim a charitable contribution on 1040 instead of Schedule A to increase my SALT deduction that is maxed at $40,000?
So your Schedule A is a breakdown of your 1040. So your 1040 is a combination of multiple schedules. And so your charitable deduction is going to be on Schedule A, which is inside the 1040, because that's where you have your itemized deductions.
Got it. All right. Jovan asking, how long do people have to get any type of credit? This was asked specifically on the solar credit slide.
So it will need to be put into service and purchased Before the phase out, if we're talking about solar, I believe your phase out, if it's residential solar property, I believe your phase out is going to be um April 30th, but it's say like it's second quarter.
Yeah, take advantage of that. Boris asking, what is an educator? The definition for that. You mentioned some benefits there.
So it's going to be anybody that is actually classifying themselves as an educator. And so if you're working for like an actual school or some sort of education, if it's inside your title as well. And this is K through 12. It has also been extended past people in classroom. It used to be just people in classroom, and this has been extended past that. And so tutors can count, coaches can count, trainers can count, but it is strictly going to be for kids K through 12. The educator needs to educate kids K through 12.
Got it. Okay. Jovan also asking, and I believe this might have been on the cost segregation slide. How will that work for first-time home buyers or one who wants to invest?
So again, the cost segregation is going to be for business use properties. And so if we're talking first time home buyers, I feel like we're talking about primary residence, because and you don't depreciate your primary residence because it's not a business. You depreciate a rental or a business, whether it's your first, second, or third. Depreciation's not a choice. We have to take depreciation, and I remind people that depreciation can be your best friend or your worst enemy, so you don't mess with her lightly. You definitely know you put some thought when we're talking to her. We put some thought because she can really just make your life a lot better, and then she can come back around and hello. And so, but I tell people anytime you're thinking about doing a cost seg, let's go on, get a free estimate. Anybody that's worth doing cost segs, like any company that will do a cost seg, will give you a free estimate, and they do it very quickly to get a free estimate. Take that free estimate, go talk to your tax accountant, see how it plays in, see how much of a tax savings you're actually saving. Because we don't want to do a cost seg on like $100,000 worth of renovations. You don't have enough depreciation to accelerate where your tax savings makes up for it. Your tax savings probably will just cover the cost of the cost seg. So like we're netting zero, here. We want to make sure that it actually makes sense and it furthers the goal. So like what's the actual goal? We're trying to buy another rental. Okay, great. How much of do we actually need?
Yeah, good point there. Donna was also asking, I believe, about cost segregation, if she could use this strategy if she plans to sell next year.
Okay, this is when we're dealing with depreciation and her being like, real. I say it's a her. It's for sure a female. When she can be your best friend and worst enemy, right? And so, like, depreciation sits with you forever. When we reduce our basis, we're going to have some issues. And so, if you're trying to sell next year, what are we doing with the sale? Yes, you can use that strategy, but what are we doing with the profits? Because we're going to reduce our profits, and we're going to or sorry, you're going to increase, I guess, your profits, which means more capital gains that we're going to have. And we are going to have to recapture depreciation. And so are you going to sell and reinvest? Because then we can do a 1031. And it doesn't mean you need to do a 1031 completely. If you want to sell so that you can take out $50,000 and then you want to reinvest the rest, great. We can do a partial 1031, and then that's totally fine. You have to really think about these things long term. It's like, what's the goal? What are we trying to do? Because yes, it can be done on a property that we're going to sell, but maybe it's not to the best benefit. Maybe there's something else that we want to do.
Yeah. Okay. Also on cost seg, how long do you have to keep the short-term rental and do cost segregation before you convert it back to long-term, if at all?
You don't have to do a cost seg, and short term versus long term don't apply.
Mm-hmm.
Like those are two completely separate things.
Nice. Bruce put in an AI summary. If you guys want to look at the chat right now, you can click his link there to download it. Thanks, Bruce. Alexander asking, can I depreciate master lease.
Hmm?
I'm not sure what that means. Okay, Alexander, give us a little bit more context on what you mean by master lease. He capitalized master and lease. So I'm wondering what that might be. Let's see. All right. Oh, you have something?
No.
Oh, okay. Miriam asking, is the auto interest deduction also for non-itemizers?
No, you gotta itemize.
Mm. Darn. Okay, another one here. Do you have any recommendations on a cost segregation specialist? Does the firm work with any that you would recommend? Okay.
There are two that we do work with quite closely. I do have one that I do prefer just because I like the way he communicates.
That's helpful.
But and it just makes like life easy. If you send me an email asking for it, send me an email to nicole.green at roberthalltaxes.com. I can connect you with them because
Great.
he's great. There's a couple of them.
Awesome. Yeah, and I'll email you Nicole's email and also the slides and recording. Just a quick reminder if you didn't hear me say that earlier. So you can reach out to her for any of your needs. Also, Gloria asking here, what does itemized versus non-itemized mean?
So when you're looking at your tax return, you have your total income, and then you get it, everybody gets a deduction. They either get the standard deduction or an itemized deduction. And itemized is going medical, interest, salt taxes, and charitable contributions. And that is you pick whichever one is bigger. Once you add up all your itemized deductions, you pick whichever one is bigger, and yeah. If the
Okay.
standard is bigger, then you take the standard.
Yeah, exactly. Miriam says the auto interest deduction, is it only for brand new vehicles?
No, ma'am. That is not just for it's all you have to do is own the vehicle and it paid the interest. So if you pay interest on somebody else's vehicle, like it's in somebody else's name, it doesn't count. It has to be assembled in the United States and it has to be you paying it on a vehicle you own.
Okay. Paul says on a partial 1031 exchange, is there a percentage limit or requirement?
It depends on, that's a little bit more of a complicated question. It depends what we're doing because then it can fall into like down leg, up leg. You can do, but essentially you can take out quite a bit, but you need to keep in a lot of the you need to keep in a lot of your bases in there. And so it depends on kind of how are we going into a smaller or larger? Like I need more info before I can
Okay.
answer.
Good to reach out to Nicole for that. If you aren't going to put in more info there, you can probably get more specific on a call with her or email. Gloria asked earlier in the presentation, what type of account is the child account you were referring to? Is it an investment account or savings?
It is going to be think it's going to be treated just like a traditional IRA account.
Okay.
Yeah, so it's going to be a
Straightforward.
retirement account and it'll be just like a traditional IRA.
Nice. Heidi said to purchase a 2023 car, partially loan, is it deductible? Partial. Maybe she meant partial loan. If
Are
a
we are
2023
we
loan is
ta so
deductible.
are we talking about the standard deduct? I mean, are we talking about the mortgage interest deduction or sorry, auto loan interest deduction, or are we talking about like a business deduction? If I think you're
Mm.
talking about the auto loan interest deduction, and if you're, it's just on the interest that you're paying. Whether the car's $100,000 and you put down 20, and now you have an $80,000 interest, you can take up to $10,000 of it, of the interest. It that
Yeah.
yeah, it's
She
just
says auto loan ish interest.
yeah, it's just how much ever interest you have. You can take up to $10,000.
Nice. Okay. Frank says, what is the limit convert IRA to Roth IRA?
It depends on your AGI, but you can really do anything, to be fair. You can do a jumbo, you can convert as much as you want. But just on a no, I always say why. Like, why are we paying so much in tax? Like, I know a lot of financial planners love it. I mean, I just think they get also commissions off of it as well. So, like,
Yeah.
of course they love it. But yeah, it should be done strategically because you can still use retirement accounts. People think these retirement accounts are sitting there and they're completely locked up. They are great ways to invest in other businesses. You can have a self-directed, you can buy crypto, you can buy a rental property, you can buy a business with your retirement. There's so many different ways that you can use your retirement account. It doesn't just have to sit there.
I like that. Donna says, can I do partial or full 1031 from my rental property in California to put into building an ADU on my primary property?
Yeah.
Okay. Well, we got plenty of 1031 experts as well that present. So be good to maybe connect with one of those. Also, Ruth was asking, what about setting off Medicare IIRMA? Irma? Not sure I know what that is.
I don't know.
Okay, maybe Ruth, a little more context on that acronym there. And Gloria, going back to the, what did she say? Maximum AGI.
Oh, are you talking about Social Security?
Perhaps, yes.
Yeah, so it's a top line deduction, and so it actually doesn't show it. So
Mm, okay. Yeah, Medicare premiums. Got it. For part A, she says. Okay. Gloria says, going back to that child account, on the child account, if a family member contributes to it, is it a deductible expense for them?
no.
Okay. All right. Well, let's go back to the Q&A box here. Alexander came back. Another question. Can you explain the key differences and tax benefits of owning a California investment property personally versus through an LLC, especially in relation to the California Big Beautiful Tax? I like it.
So,
See what you did there, Alexander.
so in general, putting properties inside LLCs is for insurance reasons. Like think of it like insurance. It's for liability reasons. Is there a big difference if you have it on your primary versus like on your own personal tax returns versus it being inside an LLC? Not really. However, like if you did get sued, there's going to be some limitations. Would I ever recommend somebody put one property if they have like or put four properties into each of their own LLCs? No, because there's carrying cost. Like it costs to have LLCs. It costs you pay, especially in California, it costs quite a bit. You pay the state, you pay for the tax return. There's a bunch of different things for it. But there I have a bunch of rentals, and I have them split. Probably I should split them more, but I have them split into a few LLCs. It also does allow if you're going to kind of be if you're going to be a really kind of big investor in LLCs, that you can now have these subsidiary companies and then have a mass like managing company, which would be like an S corp or whatever, and you have these LLCs flow through it. But in general, just long story short, LLCs are liability protections for people with rentals.
Right. Oswald, 100 rentals is amazing. Nice.
No,
Okay.
I don't have 100 rentals. We have 64. I have 64
That's
rentals.
amazing too.
Yeah, it's me and my dad and my uncle, but
Amazing. I love
yeah,
that.
it
Yeah.
real estate has just turned out to be the best invest. I mean, year over year, historically, it's just the best investment.
I'm sure many of us agree here on this webinar. So, Lynn says, very informative. Looking forward for the recording to watch again. I really appreciate some really nice comments as well here in the chat. Thank you guys.
Oh, thanks.
Going back to Alexander, actually, I just realized it's a different Alexander who asked the earlier question about the master lease. I asked for more context. He said, a master lease. I have 30-year master lease for a large property rented to 20 different renters. So I think what he's asking is if that changes anything in terms of depreciation with that kind of setup.
Got you. So depreciation is all about the first year put into service. So this is not necessarily going to be the probably the best strategy for an existing property. And again, I remind people that you need enough depreciation to accelerate. And so we've already have these properties. We don't get bonus depreciation because it's not the first year that you put it into service. So we can't really accelerate very anything, like not very much, can't really accelerate anything. And then also we need to have enough depreciation to be able to use and accelerate.
Okay. Hope that answers the question there. Going back to the other Alexander, do you keep your rental properties in a trust or under a different type of ownership?
A little bit both.
Okay.
A little
I
bit of
like
both.
it. Donna says in all caps, thank you so much. I really needed to hear this. Great job.
Let me go back. Thank you, Donna. Let me go back really quickly about the trust situation. So, a trust and an LLC are two different things, right? A trust is to help with beneficiaries when you die, while an LLC is to help with you currently, unless we're talking land trust and that helps with privacy or whatever. But trust and it's not either or trust or LLC. It's usually you want to do both because you just put the LLC inside the trust. And so,
Okay.
in general, if you have any type of assets that you're going to leave to people when they pass away, it just makes it a lot better for it to be in a trust. You don't have to go through probate. You don't have to get an attorney. All of those things. It determines already who is it is when you die.
Yeah. Eric, also going back, I think you kind of answered this, but do you have an LLC for each property you own?
No,
Or
no,
should you?
no, 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 no,
Okay.
no, no. That's too expensive.
It's a little
Like
overboard. Yeah, it's a lot.
that's
It's
a
not,
lot. And like it's
yeah.
annoying to like no. I put several property and you have to look at your property. So like if you let's say bought something that you're renting out to college students and then you have a couple of single family homes. Maybe the one that's going to college students you put inside an LLC and the other ones you put in their own LLC. You know, like you have to look at whichever one has the most risk. I'm not an attorney. I would consult an attorney about that.
Yes. Steve made a good point that that could trigger the city to reassess your property taxes. So be careful.
You have to maintain ownership. You'll be exempt
Right.
if you maintain over. So if I'm 100% owner of my property and then I transfer it into an LLC, I need to be 100% owner of the LLC and it won't
Hmm.
trigger property tax reassessment. But if you're like 50-50 with you and your spouse, then you have to put it into a partnership because you need to be 50-50. It needs to be the same.
Yeah. And also, does it change anything if the rental property LLC is out of state? Should it be added to your trust?
Yeah, anything you own that has an asset inside of it should be inside the trust. But no, it doesn't change anything.
Okay.
It's yeah, you put the you create the LLC wherever the thing is. So like we have rentals in Texas, we have rentals in Florida. They're they're friendly states. We have rentals here in California too. Oh.
They appreciate at least. So,
Yes, actually, they generate actually the largest profits too. But oh, they're a bear.
mhm.
They're a bear. With everything, there's a give and take, right? You
Of
know, everything has
course.
good and bad.
No such thing as a free lunch, but we do what we can. Dominic says, have you heard of the possibility of loans being recalled when putting them into LLCs?
So people get kind of nervous about that. I will say technically, because this is being recorded, I will tell you technically you do need to tell the mortgage broker and your lender that it is changing. Have I done that with every property that I have owned? No.
Okay.
Have I seen any problems with that? No.
I see. Okay. We'll take with that what you want. Miriam asking another question here on the LLCs. If you live in California, oh, maybe this is a comment. If you live in California, you have to pay the $800 minimum franchise tax for each LLC, even if they are in other states.
No. You don't pay the franchise tax board for an LLC in a different state.
Ha, okay. Good to
But
clarify
you do
that.
pay but you do pay for filing and stuff. And yes, because you pay there is a tax for an LLC in most states. Most states actually charge. Sometimes it's $50, sometimes it's, $100, sometimes it's eight. California is one of the highest for sure.
Yes. Eric also says, with several properties under one LLC, doesn't that expose the properties in the event of a lawsuit?
It does.
Mm-hmm. Yeah, and we've had estate planning attorneys come and do a couple webinars a year on that topic. So it certainly is something to consider, but there are other options to like trust to also have some similar kind of legal protections.
Yeah.
Yeah. And Mark says, can you avoid the LA County tax reassessment if property is in an LLC and we leave our shares of the LLC to our children? Might that be like a step up in basis?
When the kids
Mm-hmm.
inherit it, they're going to get the LLC. Sorry, they're going to be reassessed regardless because that prop just changed. And so if it's not a rental property it has to be a primary residence to you and a primary residence to them to avoid the reassessment for when the kids inherit your property.
Okay.
But on a side note, don't put the kids on the LLC to avoid the reassessment of property tax. Accept the fact that you're going to get reassessed because they will get step up in basis when you pass away, when they inherit it. If they are on the LLC, they will not get that step up in basis. And that step up in basis is the most golden thing absolutely ever. Because if they decide to sell, and especially if you got multiple kids, some people might want to sell, they can sell tax free. So it's that step up, and it's just a new depreciation. It's a new everything that they have. That step up in basis is absolutely more valuable than stopping the reassessment of property tax.
Hmm. Yep, yep. That's one of the key reasons that we do the 1031 exchanges, right? Rosalie actually was asking earlier if you've heard of any changes with these 1031s and trusts or if things are still the same.
Things are the same from what I know.
Okay, good news. Heidi says, I'd like to learn how to scale up rental properties, specifically out of state, to get to 100 properties. So I think this might go to kind of how you grew your portfolio, Nicole. And if you have any advice there, I know we do some workshops, is a little off topic, but it'd be nice to hear any words of wisdom you have to share.
Um, At the moment, it's all about timing, I would say. At the moment, we haven't bought anything in the last 4 years or so.
Mm,
We went on a real big buying spree, but like the markets, just you got to find the good deals. To be fair, I don't buy anything that's lower than maybe a B class. Maybe it's really all A class properties just because I'm the one that manages them. I don't like property managers. Sorry, I just don't. And yeah, but you also have to think about what your strategy is. We're doing a very long term, we have very specific reasons for having such a bit. I mean, very soon we're God willing, we're planning on selling almost everything and just buying one big, large property, like 100 units or so, and then I can back out of it. But if you don't have rentals, I say start with one. But also I would also recommend don't be afraid of an out of state rental. I People a lot of times get really scared about like, oh, I can't go to the property. How can you need to go to the property in the first place? Like when somebody calls me about a plumbing issue, I can't fix that. I call a plumber.
right.
Like, so
Right. Yeah. Yeah, it's true. I mean, everything's virtual now anyway. I mean, more than ever, today would be the best time to do that, right?
yeah.
Marilyn says, going back to our LLC discussion here, if we have a rental properties in Los Angeles, California, but the LLC is registered as she's put OZ in Texas, why do we have to pay the franchise tax in California?
because it's in California. And so you should have your LLC registered also in California. Remember, you can register companies in multiple states if they operate in
Mhm.
multiple states. And so you're probably also registered in California because you're generating income in California, you're maintaining the LLC in California, and California says, give me money.
Okay. Let's see. Another question here. What is A class, B class?
It's just the different levels of work that you need to do on a property. It's really defined when the property was built and how the property was built. But basically, A class is just going to be like brand new properties, no like renovations or like work necessarily needed for quite a while of time. While B class maybe need a little bit more, a couple more people have lived in it or owned it, and then C and then D, and like D is like fully gut reno, take it down to the studs and all that kind of stuff.
Hmm. I also hear from Barbara, we have been paying $800 annually for many years. I believe this is for the LLC. Now we realize that our property title was not in an LLC. Can we get a refund from the state?
If you're paying $800, you're paying it because it's an LLC, regardless of what's inside it, regardless if it's active or
Mhm.
not. You're paying because you have the LLC.
Right.
So no.
Right. Darn. Just fix that moving forward if you
Yeah,
don't need
close
it.
it.
Yeah. Okay. The AI summary was not working. It's working for me. So I'll send you guys the link afterward. Thanks again, Bruce, for dropping that in. And Alexander just wanted to say a note here. January 1st, 2026, Texas rolls out a new eviction law designed to streamline and speed up removals of unauthorized occupants. A big win for landlords. I'm sure you're aware of that, Nicole.
Texas, Texas is great in that. I mean, I live in California, and trust me, I'm not moving. Um, but Texas is great for landlords.
Very nice. Okay, Dominic says, isn't a sort of on the follow up on the LLC questions? Is an umbrella policy in lieu of LLCs for protection a solid strategy?
That's a personal question.
Yeah, talk to insurance provider, estate planner. When properties are held in a general partnership, is tax reassessment a problem when putting into LLCs?
A general partnership is like type of an LLC, and I mean, no, as long as you can move things around as long as the ownership stays the same.
Okay, Eric says, is a pass through LLC subject to the $800 minimum tax per year in California?
Yep, all LLCs are passed through.
Well, they're going to get you one way or another.
California needs and wants money.
Yes, yes. Okay, so I think that ends questions. I don't see any more coming through. That was so fast. I think we answered like 40 questions, which is amazing.
Just bam.
However, yeah, gold star for Nicole, as usual. However, if you do have a question, you start thinking about that after the webinar. Again, I am going to send the email with the recording, the slides, Nicole's personal email that she is sharing. And so you guys can reach out to her directly. I hope you will take her advice or ask her for advice. And the Robert Hall and Associates team is excellent as well. So I hope that you all learned a little bit. I'm getting lots of thank yous. Please take the exit survey. I'd love to hear your feedback, some suggestions for webinar topics next year. And we do have one more webinar left this year, which is going to be about rising utility rates. Sorry to break the news, but that's a thing. So we're going to go over what's happening on a national scale, where we're seeing those utility rates increase, what you can do to potentially bill your tenants if you're not already, and other ways that maybe you can mitigate some of those increasing costs. So hope to see you next week. And Nicole, I hope to see you again soon as well. Thank you so much. Excellent job.
Thank you. Happy holidays, everybody.
Yes, happy holidays. Bye.
Bye.